equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. And whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. Now, if you have just joined us, welcome to the Equity Mates community. A massive congratulations on starting your investing journey. If you are still getting up to speed, we do have a second podcast, Get Started Investing, that you might find helps you get up to speed with all of the basics. Now, while we are licensed, we are not aware of your financial circumstances, so please keep in mind that all information on this show is for education and entertainment purposes only. Any advice is general. With that said, my name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited. We are recording this on a Thursday afternoon, and this time next week, we will be in the United States on our way to Warren Buffett's annual general meeting.
Absolutely. We'll be in LA warming up.
Yeah.
Getting ready to fly across to Omaha, Nebraska.
I think Alf booked our LA accommodation and he's chosen a hostel in Hollywood.
Hell
so
yeah.
go over to our Instagram to follow our journeys over there. But this is a real bucket list item for you and I and something we cannot wait to go and do. And we'll be bringing it back to the Equity Mates community. We're taking recording gear over there. So stay tuned to the podcast. And if you want to follow us day to day, head over to Instagram at Equity Mates because we're going to be producing some content.
Yeah, coming at you live, well, very close to live on our Monday episode on the 8th of May. We're going to be doing a pretty hot off the press first reaction from the Berkshire Hathaway AGM.
Yes.
They've got a fun run the following morning, which we will probably hopefully get some interesting content from as well. So make sure you're tuned in and dialed in. Tell your mates if they want to get an insider's view into what goes on at Warren Buffett's Berkshire Hathaway AGM alongside 40,000 other investors from around the world. Over the next month, we're going to be having plenty of content both on socials and on our podcasts.
Yeah, but Bryce, you started this episode, the way you start all episodes, by saying something about investing journeys. I don't know, I kind of tune out with the intro sometimes.
That's fair enough, me too.
But we have been doing a segment that has been continuing our investing journeys, and we've each found a coach, a mentor, a sensei, a guru, whatever you want to call it, to help us on our investing journeys and I guess also hold us accountable a little bit to keep doing the work, keep becoming better investors, keep finding new ideas. You have been working with Henry Jennings of Marcus Today.
Yes.
And I've been working with Andrew Page of Strawman.
Yep.
Earlier this week, I sat down with Andrew and had a mentored session, and we've got some of the clips from that for today's episode.
Yeah, I'm looking forward to it, Ren. Haven't heard how it goes, but I know that the homework for you was to bring a few ideas to go through with Andrew. So keen to hear how that pans out. Yeah,
so we get to that. There's two companies that we go through in this episode. Ordinate, AD8 is the ticker, and NetWealth, NWL is the ticker. In my last mentored session, Andrew and I had this conversation about a company that was pretty popular in Strawman, his investing community. So he didn't tell me what the company was, but I went away and I wanted to try and figure out what it was. And so I did some work on that, and I kicked off this session with Andrew throwing out my guess as to what the company was. Andrew, thanks for joining me.
Yeah, I'm psyched for it, man. I'm enjoying the journey.
Yeah. Well, last time we spoke, we unpacked investing philosophies, and I had a bit of homework to go away and bring a couple of ASX listed companies to discuss. We got a lot of feedback. People loved your quick breakdown of hit IQ just on the fly.
Oh, cool.
Yeah. So I'm excited to talk about a couple of companies now that I've given you a heads up. And but before we get into them, part of our conversation actually got edited out. But you mentioned that there was a company that was doing the rounds on Strawman that had it was about a $10 million market cap and was profitable. And I said, don't tell me what the company is. Let me go away and see if I can figure it out. So I want to throw a guess out there. If it's wrong, don't tell me. I'll try and figure it out again.
Okay.
Oh, the other piece of information you gave me was it was based in WA. So I went on Ticker and they have a stock screener. So I went ASX listed, less than 15 million US dollar market cap. Who knows how it would have moved, and greater than $0 operating income. There are 55 companies on the ASX that come back when you search for that.
Can I just pause on that for a moment?
Yeah.
Surprising, right? Like that's a pretty small, it's a pretty tight filter in terms of size and profitability. But I guess I just underscore that as just like that's a lot of stuff to dig into. Maybe you'll dismiss some quickly, but this is always sort of my thing that I want to impress upon people, that there is wonderful opportunity at this end of the market, right? It's not all unprofitable cash burning scams.
Yeah.
They're there, but there are some real businesses there too. And you know what? No one else is looking at them.
Yeah, I was surprised because, yeah, you're right. My perception is they're companies that are losing money because they're failing or they're losing money to grow. I was actually a little bit disappointed because I was hoping the filter would return like 10 companies and I'd be like, sweet. And yeah, I guess the other thing is if you're a $10 million company and you're profitable and you're not trying to like burn money to grow or anything, you're probably not listing. You're probably just a small business that's operating.
Yeah.
But yeah, so it was surprising.
I mean, we were talking off air. I mean, there's a lot of downsides to listing. The only reason you would list, two reasons. One is you want access to equity capital. So the market is a great mechanism for raising money when you need it without having to borrow from a bank. But let's be real. The other main reason is exit liquidity for founders, right? So and then with that comes a whole bunch of extra costs and regulatory requirements. You got to deal with bloody investors all the time. You got to produce quarterly reports. You know, as soon as there's like any kind of a wobble, everyone punishes you. It is not always a good thing.
Any material thing that happens in your business, you have to tell everyone straight away.
And the market's just like really myopically short-term focused as well. So it's just like, I think anyone who's run a business knows the reality of that. Even great businesses, nothing goes in a straight line. There's always challenges, but as a private business, you get to run it. Well, I was going to say for yourself, but for your small group of investors, I think you get to operate in a much longer time frame basis, where the incentive structures drive you towards very narrow short term. What are we doing this quarter? What are we doing this quarter? And that's generally not a good thing for the long term viability of a business. Most businesses that do really well are planning years and years out, and they're the overnight success that is 10 years in the making kind of thing. You're just never going to get there if you just continually, bending to the whims of the market.
Yeah. So I scrolled down that list of 55 companies and it was pretty quick to veto some. Like I have a general sense that you're not going to be investing in like a specky mining company or a specky like bio pharmaceutical company or something like that. Maybe I'm wrong, but that was
never say never, but no, you're not.
Yeah. That was my general perception. So my guess this week, a company that met that filter based in WA, Advanced Braking Technology, ASX ticker ABV. Give me a quick yes or no.
No.
Okay.
but yeah. Like you sent it, I thought, wait a second, this is actually kind of an interesting company.
Really? So, okay.
Well, I mean, I may have come across my radar at one point in time, but I sort of forgot about it. But I mean, as you say, it's sort of profitable. It's growing. It's got no debt. It's got some cash on the balance sheet.
Let me give the numbers. So this is why I thought it could have been your company. So calendar 2022, so last 12 months, $12.76 million in revenue, $1.3 million in profit, and a $15 million market cap. So about a 12 PE. And it's growing. So revenue has grown from 6.8 million to 11 million between financial year 19 and financial year 22. So compound annual growth rate of 17% for revenue. First turned a profit in 2020 and has been profitable ever since. It seems to have all of the major miners as customers: BHP, South32, Fortescue, Rio, Newcrest, Glencore. Oh, by the way, what it actually does is it makes sealed brakes for heavy vehicles. $2 million cash on the balance sheet and zero debt, as you said. And so I was like, that seems to tick a lot of the financial boxes for Andrew. My question was around what this could be. Like, how big a business could this advanced braking technology be? Could it expand outside of mining, or is it just a great small mining services business?
That's an excellent question. I don't know the answer to it. I mean, there is something to be said for knowing your niche and staying within it. A lot of companies undo themselves. They have wonderful little core operations, and in the pursuit of growth, they go into other areas where they don't possess the same kind of competitive advantages. Or if they do, they've got to spend a lot of money and time building that up and breaking that into the market, which just, dampens what the other part of the business is doing. And if it doesn't ultimately work out, you end up burning a bunch of shareholder capital. So you've absolutely got to ask that exact question. The big picture is really nice. Like, as you say, it's profitable. It's growing, robust balance sheet, so the natural question here is, and this is what we'll get into in later episodes, is like, okay, this is something. The next question is sort of like, well, as you say, how big can it get? And it might not be just as a theoretical, exercise here, it might be that it never grows from here. But, if it's on like, if the multiple's low enough, that can still be a phenomenal investment. If you had a business that only made, $10,000 each year and that's all it was ever going to do, there's still a price you would pay for that, right?
Yeah.
Doesn't have to grow, but yes, I think that is the absolute right question. So yeah, definitely one to look into.
So you manage a great community of investors of all types, but I think there's probably a focus on some of the smaller companies in the market. If you look up advanced braking technology, is there any chat on Strawman about it?
I did have a quick look. Actually, no. So there was one note there from 2 years ago. No one's holding it in their sample portfolios, but 3 people are following it.
Great.
This is the thing, right? Like, I'm surprised at how long I've been in this game, and particularly running Strawman, where we really focus on the small micro caps, and there's a lot of smart people out there hunting for these things. It's just amazing how many things you can still miss.
Yeah.
And like, when you first sort of suggested ABV, I was like, yeah, why isn't this getting more attention? And maybe by the way, I'm being there might be something that if anyone's, gone beyond a high level look here, that maybe there's a whole bunch of real things you need to worry about here. But at a top level, I can think of far worse starting points, put it that way.
Yeah, great. Well, maybe throw it out to the Strawman community and see what they think. But I will continue on my quest to figure out what this company is. I guess I'll have to keep scrolling down that list of...
I'll give you another clue to help you. Its trailing 12 months revenue would be in excess of 100 million.
Wait, what? And it's trading for less. It's trading for 10 million.
Well, sales are one thing, profits are another. So the margins are pretty small at this point. So
more than 100 mil.
More than 100 million revenue.
All right. Well, that's going to massively reduce the number of companies I have to scroll down.
Be aware too. I'm not familiar with ticker, but you will sometimes miss some of these things depending on the data provider and how they've sort of scored all of that kind of stuff. So sometimes these things, which is why I'm always such a big believer in going to the source material. It's free and I'm very tight, so that the pricing is right. But you just go to the ASX website, get it straight from the horse's mouth, right? And I know this very well because we've used Morningstar. We're currently using Standard & Poor's for our data provider. We pay a fortune for that bloody data, I can tell you. Which is a whole other rant for another day. But you'd be surprised at how many inconsistencies there are in the data. So it's really useful, these tools, but just always do a sanity check with the source material.
Yeah, I'm not going to name and shame the platform, but there's one platform that I used that had that problem in spades, and I eventually had to leave them. When you say you go to the ASX website, though, does the ASX have a stock screener or something? Like,
no, I don't think so. I just mean the announcements page.
Yeah. Okay. Yeah. So, but this is for my investigative work. The ASX website isn't going to help me there.
No. That's where scans can be helpful. It's just like it's a good first step.
Okay, Ren, so now you've got more pieces in the puzzle, 100 mil rev.
Yeah, 100 mil rev and a $10 million market cap.
Okay, and you're going to go away and find out what this company is.
Yeah, now you're the retail whisperer, and all it made me think was if a company is making more than $100 million in sales and is profitable, but has a market cap of less than $10 million.
But it's based in WA, isn't
There
it?
are retailers in WA.
It's got to be resources.
Australia's best retailer comes out of WA.
Wes Farmers.
Yeah.
Yeah. It's not Wes Farmers.
It's not West Yeah, but mining would have better margins than that, wouldn't it?
What's the margin? What was the margin?
Well, it's over $100 million in rev,
yeah.
and its profit will be less than $10 million.
Oh, okay.
Because if its market cap's only 10 mil.
Okay. 100 million in rev, 10 mil profit,
No, 10 mil market
10
cap.
mil market cap. Or maybe it's just seriously
Undervalued.
Yeah. Isn't that the whole point of Andrew? Like he finds this stuff?
Maybe.
Yeah.
Maybe. Anyway, so that's my homework. So I've got to go away and figure that out. But then we got to the rest of this mentored session. I had done some work, started researching some companies, and wanted to present, we're Andrew and I think you and Henry as well, are really chasing sort of long-term compounders. That's
No. We're chasing 6-week 10
you
baggers.
Okay. Well, Andrew, the reason that I wanted Andrew to be my mentor and what I want to get better at and be more disciplined at is that deep stock research and trying to find those few high quality companies. And so I've done some research and I brought 2 companies to Andrew that I thought could be good ideas. And so this is me presenting the 2 to him. So let's turn to, so I've brought 2 companies today that I want to chat about. The first one is Ordinate, ASX ticker AD8. And then the second one is NetWealth, ASX NWL. Both of them are smaller companies, not tiny. And both of them seem to have compelling stories. And so, in our pursuit of trying to find smaller companies that have potential to compound for years into the future, they both seem like ones that are worth talking about. I assume you're familiar with both of these companies?
I am. I'm more familiar with Ordinate, but yeah, really interesting choices, man. I'm happy to dig into them.
Ren, we've just got to jump in and quickly pause here. I wouldn't say that interesting is the tick of approval that you're looking for from Andrew.
Yeah, I was hoping for a bit more like 2 great choices.
Investing's hard.
2 interesting choices. But we get into
Meaning
it.
he's probably already looked at them, you would imagine.
Well, you'd think so, yeah. Yeah. Hopefully he means interesting in a good way. Like,
Yes.
these are stimulating choices. So we start with Ordinate. All right. Well, let's start with Ordinate because you're more familiar with it. So they develop and sell audiovisual networking solutions to leading equipment manufacturers. That's the jargony way of saying they create software and hardware that a whole bunch of different audio manufacturers, the Boses and the Sonys and the Yamahas of this world, then put into their technology, like put into their equipment. Is that fair?
It is, but the point I would emphasize here, and this is what's always interesting, if ever you see what you might term a structural disruption within the industry, in other words, a new way of doing things comes along that threatens to completely upend and displace the existing incumbents, huge amounts of value is created that way. I mean, you only need to sort of look at the Amazons of this world and what the internet has done to places like, retail and media and everything. It's you have these industries that operate for decades, eventually, a few rise to the top and just dominate it. And they're very hard to displace. But when a new way of doing something comes along, often these companies dismiss them. I mean, Kodak, I think we may have mentioned before, classic example. They invented the digital camera, but it threatened their business. And, it's like they in retrospect, the smart thing to do was to kill their own business because someone was going to do it. You might as well kill it yourself and then own the new normal. The reason I mention this is that Ordinate, they're doing it in a completely different way. So anyone who's ever worked in the industry would know that there's a lot of cables. There's a lot of analog kind of stuff, and it can be an absolute nightmare setting up any kind of recording kind of system. So this is digital. And it feels funny to say that in the year 2023. It's like, what? It wasn't digital? It was like, no, it was analog kind of technology. So they invented this platform called Dante. And by the way, there's lots of companies that sort of promise to do this. Where Audinate is really fascinating is they've done it. Like they won, right? It's kind of, and there's still a long way to run. So that's really interesting. The other thing that's really interesting is, and this is probably my two favorite words in investing, is network effects. Because these guys' tech is being integrated into some of the major producers, and because people want tech to talk to different parts of tech, if Dante has become the standard within the industry, any kind of related product needs to be interoperable with all of that. So it really doesn't become a choice. Like smartphones, right? What are you going to use, Android or Apple? What's your third choice? There is no third choice, right? If you want digital audio networking, what do you use? There's Audinate, and there's like 2 or 3 others. And all I would ask you to do, I know you've done this, but for those playing along at home, open up one of their recent prezos and they'll show you exactly, like there's them and then there's daylight. As each day goes past, they're increasingly difficult to displace, and it looks like they've kind of won this race.
Well, yeah, that was probably the thing that was quite compelling, because you look at the financials and, their share price is up almost 50% in the past year, more than 20% compound annual growth rate over the past 5 years. Great. Revenues tripled since 2017. Great. But your point around the adoption of their technology was the thing that was quite compelling. And this feels like a winner-takes-all market, as you said. Like there will be a standard protocol that audio engineers are trained on, and that different pieces of technology need to talk to each other. And there was a chart in one of their prezos, and it tracks the they call it audio products per protocol, and it's basically how many audio products are using their Dante software and hardware, and then some of their competitors. If I can read this text, Ravina, AVB Milan, and then others. And the chart for them is just up and to the right. It's now 3,688 products are using their protocol. Next biggest is 300, and then 130 after that. So it's just
game over. Yeah.
The story's there in that chart.
They won.
Yeah.
They've won. I mean, they could completely stuff it up. There's always something that can come out of left field that displaces everything, but it looks like they're in an incredibly strong position in audio.
I guess the question then becomes, and this is a question I have for both companies that I want to talk about today, because they're very different in terms of financials. Audinate, not profitable. Net Wealth, very profitable. How would you then go about saying, okay, Audinate look like they're winning this race for audio protocol supremacy. Management think that there's $1 billion market opportunity there, but management are always going to give you the rosy picture.
Sure.
They're currently not profitable. How do you go about starting to think about, well, what's the right price to pay for a company like this?
Yeah, it's a great question, and this is a great example. There are really good reasons as to why you wouldn't be profitable. In fact, why you might not even want to be profitable, because it's not so much. I mean, think about anyone who's done a business, right? I mean, until you sort of get everything set up, I mean, you by definition not profitable, but that work isn't wasted. You've made an investment, and that return might not come in any given financial year, but it's the whole thing that you're trying to do is ask, as an investor, what's this economic machine taking in and what's it going to spit out? Now, the industry and analysts and that will always focus on this year, next year kind of thing. But you've got to look out over the life of the company. I mean, would you buy a company off me if I was bleeding $1 million a year for 5 years? But then in year 6, I made 10 million, and then year 7, I made 20 million, and then it's probably really good. And it just, and if I spent that money, if I was quote unquote losing that money because what I was really doing was investing in a foundation that would support incredible growth down the track, that is not a loss at all or wasted money at all. And so I think the bull case with Audinate is that, well, when you're disrupting industry in what is seemingly a winner-take-all market, if the guys at Audinate were focused only on profitability and they weren't getting out there to as many people as they could, they might be profitable, but they might just be overtaken by the team that's got the capital to continue to invest and ultimately win. Remember, their customers don't give a stuff, right? I guess they want to know that you're going to be around, but they're not looking at it from this point of view. So you've got to solve the most problems and create the most value for your customers. And if you can do that, and it's a very difficult pivot to make, but if you can do that, then pivot to profitability once you've won the market. That's what Amazon did. It's what Uber did. It's what it's the story of when there's so much, it's the land grab is the term that's used. And so, by the way, you've got to be careful because that is a reasonable narrative. It's actually good cover for a lot of companies that are pretty crappy.
Yeah.
Right? So it's like, we're losing money, but it's only because we're doing this.
Yeah.
So it's like, yes, but you've just got to have confidence that pivot will come. With Audinate, if you dig into it a little bit more, you realize that unprofitability is a big part of it was the capture of that land grab, but also that they're spending gazillions on trying to disrupt the same kind of thing in video. So they've kind of won the audio side of things, and they're trying to do video, which is a market size. It's about equivalent as the audio market size, and it too needs to sort of be brought into the modern era. And that's why. So the question with Audinate is not whether it's making money or not. It's whether this big investment into video will pay off. If it does, I suspect the current share price will look cheap. They've got $35 million odd and no debt there. So they've got a bit of a runway, so they can afford to sort of lose money for a little bit without having to be urgently dependent on capital raises or extra debt or anything like that. So that's the question here.
Are you someone who cracks out Excel or Google Sheets these days and models or forecasts out what you think will happen and then does a discounted cash flow? Is that your valuation?
I've actually moved away from that. I think they're really helpful in understanding the mechanics and the machinery of a business. So what you really want to see is businesses that have operating leverage. So that is their fixed costs can support a much higher level of top line sales than they currently do. So as those sales come in, the margin gets wider and wider and wider. So revenue might be growing at 10%, but earnings grow at 20%. And it's earnings that really matter at the end of the day. So that's what I would be looking at here is in terms of modeling it out. So, okay, what are their main costs? Well, this is their current revenue. Here are their main costs. What do their gross margins look like? What do their current net margins look like? Okay, great. Let's roll that forward. And you can't grow without increasing costs. It costs money to make money. But it's interesting to sort of see how that can evolve. Not how it will evolve necessarily, but how it can evolve. I think though there's nothing wrong with that, except that, as I mentioned before, you do fall into the trap of false specificity, where it's sort of like you've got so many assumptions and so much detail in there that it just sort of like little inconsistencies, little errors multiply up to be huge. So I think if you're going to do that, you can always apply some really easy sanity checks. So if you've done a model and it turns out that your net margin is 60% at the end of it, it's like, well, it's not impossible. But very few companies manage to make after tax, after costs, after everything, 60% of every dollar that they sell. So I tend to go these days you can go into as much detail as you like, but I think there's a lot of value in keeping it simple. So I would sort of say, here's their revenue. How do I think that can grow? What's the kind of net margins a business like this might be able to operate on? And then the calculus is much easier. So I was sort of like, well, here's the sales. I don't know, 10% net margin. And we can talk about how you might come to a figure, so divide it by 10. There's your profit. What multiple do you think the market would pay for a company that's grown like it has and has existing opportunities in front of it? Maybe that's a PE of 20, if the growth outlook remains strong. So I've got the earnings. I've got the multiple. If you rearrange the PE ratio, you know that you can multiply those two numbers together to get a target price. It's super easy. And then I can just discount it back. So if I think earnings are going to be $1 in 10 years time, and I think the market's going to pay a PE of 20, well, therefore the share price is going to be $20 in 10 years time under my assumptions. And then it's like, well, if I want a 10% return, I just divide 20 by 1.1 10 times, for each year. And so I'm trying to do this on the fly here, but something like what? It means if I pay $9 now and I get $20 then, I'll get a really good return overall, right? And I've just done something really rough and ready there. It's only going to be as good as the assumptions I used, but it now gives me something to focus on without getting hyper specific, i.e. sales, margins, and multiples. They're still susceptible to bad guesses, and maybe the reality of it doesn't unfold as it is. But that is, I think for people who are starting out, is a much easier proposition than working out, well, what's the full-time equivalent cost of this business? What's the R&D budget of this business? What's the marketing cost of this? And you're just trying to work out 500 different line items and then add it all up. By the way, do that, but just it's sometimes easier is better.
Yeah. So your numbers there, $1 earnings, 20 multiple, discount it back, $9 share price. Is it just a coincidence that 9 is very close to Ordinate's current $8.60 share price?
No, yes, it totally is. I didn't realize that when I did that. Yeah.
All right.
But,
good to know.
but I mean, the other way you can approach it is not trying to I think it's always worth trying to have a stab at value, but you can flip it around and say, well, what does the market think? So if I look at Ordinate now, I don't own shares in it, by the way. It ranks very well on Strawman. It's ranked number 6. A lot of people really like it. So I've only got positive things to say about it. The only negative I have at it is that currently it's on about 10 times sales. That's up there. Again, not necessarily bad because they are growing very, very, very fast. I never put too much weight in analysts' forecasts, but it's interesting to see what they say. And when I look at Ordinate, the 2025 consensus estimate, and this is covered by quite a few people, it's about 10 cents per share. So they're on 85 times FY25's earnings. So an 80 PE is high.
Yes.
Unless you're going really fast, as they are. So it's not necessarily, but I'm not talking an 80. Well, the PE right now is infinity because there is no earnings. But even if they manage to flip into profitability in the coming next couple of years and earnings grow very rapidly, you've still got a pretty elevated PE. That's not bad, but it tells you that a lot of the things we're talking about favorably with Ordinate is not a secret. Like the market gets it, right?
Yeah.
So now you've got a more difficult proposition. It's not like, will this company succeed? I tend to be a believer in. I mean, you can't guarantee anything, but it's kind of like it needs to do better than the market is already expecting. That's the key thing.
All right, equity mates, we're going to pause there. That's the conversation on Ordinate. After this quick break, we're going to talk about Net Wealth, a company that has tripled its revenue in the past 3 years and has improved its profit margin from about 20% to over 30%. Will Andrew give me the tick of approval?
No.
All right, welcome back, equity mates. We are listening to my recent conversation with Andrew Page where I had homework to go away and bring a couple of companies that I thought were interesting and I thought had hallmarks of high quality companies for us to discuss. And really for Andrew to tell me why I was wrong.
That's good. Cross them off.
So we've just heard our conversation about Ordinate, ASX ticker AD8. The second company that I brought to Andrew is Net Wealth, ASX ticker NWL. As I said before the break, it's a company that's tripled its revenue in the past 5 years and has improved its net profit margin in that time. Will Andrew give me the tick of approval? Bryce is shaking his head. Let's find out. Well, let's shift to Net Wealth, which is a company that is certainly profitable. So for people who are unfamiliar, for people who don't have a financial advisor like myself, Net Wealth are one of the three sort of, I guess, disruptors in the financial advice administration business. Net Wealth, Hub24 and Premium offer advisors a technology platform to manage their clients' money and clients an opportunity to log in and see how their accounts are going and see where their money is. Net Wealth has 3,200 advisors, financial advisors signed up to their platform, and those advisors manage 123,000 accounts on the platform, and Net Wealth has $65 billion in funds under administration. Pretty big business.
Yes, although they administer those, that's not their money.
No,
They make a
definitely
cut
not.
on that money, which is why.
They take a cut. The advisor takes a cut. The fund manager takes a cut. No wonder advice is so expensive.
There's a whole podcast right there.
But if Ordinate is not profitable, Net Wealth is the opposite. They did 170 million in revenue last financial year. The 5-year compound annual growth rate is over 20%, almost 23%. So a pretty incredible top line growth story. Off that 170 million in revenue, they did about $55 million in profit. And that profit, 5-year compound annual growth rate, is almost 33%.
There's the operating leverage I was talking about.
Yeah, so profit
growing faster than
revenue.
sales.
Yeah.
Which makes sense for a platform business, right? Because if they sign up someone tomorrow, it's like, well, here's your login, right?
Yeah.
Like there's not a lot of onboarding cost or yeah, brilliant.
Now, speaking of operating leverage, and this is why I really wanted to talk about this business, pretty incredible margins, 32% net profit margins.
It's huge.
But the margins have actually got better over the last 6 years. So 22%, 25%, 35%, 35%, 37%, and then back down to 32% in the last financial year, which is what I assume is a big green tick.
It shows you that not only is the business growing its sales, but it is becoming more efficient at converting those sales into profit. 32% net margins are very rare.
Yeah.
Very rare.
Yeah.
Yeah.
And then finally, $88 million cash on the balance sheet, no debt. And something that we hear from a lot of expert investors, you want founder-owned businesses and you want alignment between minority shareholders and management. How's this for alignment? The founder and his family own 53% of the business.
It's pretty cool.
Yeah. So
it's what you might call a sidecar investment in that regard, in the sense that whatever the founder and family want to do, they will do. They've got the voting rights. There's nothing you can do. So you kind of along for the ride. A lot of people probably look at that and go, well, isn't that the case? Because I've got 0.001% of the companies. I'm pretty much that. But it just means that while it's great for alignment and all the rest of it, and they're trying, it just means that they get to call all the shots without recourse.
Yeah.
Not a negative, by the way. I mean, they built the business, they've grown it. So, I mean, again, credit where it's due. It's not. I'm not trying to put it as a negative at all, but they will do what they want to do.
Now, the reason that I wanted to talk about valuation is because it feels like there's a lot of green ticks in that story. Here's where the challenge, I guess, is for an investor. They're currently trading at a 55 price to earnings ratio. So the market is certainly aware of them and they're not cheap.
Yeah. I think it's also worth understanding the, what's the word for it? The quality of those revenues as well. And this isn't a negative. I mean, well, you've got to deal with things as they are, not as you would have them to be. And the reality of it is that their customers, financial planners and financial types, we actually operate in a pretty cyclical industry. So when markets are in a bit of a funk, the fund flows don't do that well. The financial planning outfits don't want to onboard to a new platform. So I think, and again, I'm not trying to throw shade on this at all, but I think it's something to bear in mind that if we were ever to get into a negative environment for investing, and, it's not a question of if, but when, because that's just what markets and in the investing world does. We sort of move in cycles. These kinds of businesses can move around a little bit. The counterpoint to that would probably be with Net Wealth is I think they own like 6 or 7% of the market share.
Yeah.
So there's a lot of room to sort of grow within that. It's not as though they are a mature business. So maybe the industry overall does it tough, but they continue to steal a larger and larger part of the pie. And so that can still work out pretty well. But I just make a mention of it though as well, because I have seen it in this space before. You see it when we've seen it with Magellan recently, right? With fund flows and how quickly things can turn around when you're forced to sell a bunch of stuff to meet redemptions and the rest of it. It's kind of madness, because you kind of think in a lot of ways, if people were saying that these would be the times that money would be flowing into the market because things are cheaper, but it just doesn't work that way.
Yeah.
I just say, bear in mind that cyclicality and what you might have here is the challenges for these businesses that are on ostensibly high multiples is that when there is a bit of a turn, let's say there is a bit of a turn and they hold up rather well. So FY22's earnings, I'm just looking here on CommSec, per share there wasn't a lot of growth from the year before, even though sales went up quite a bit. So there's probably a big investment in tech
their margin also got squeezed. It went from 37% to 32%.
Ah, that's right. You said, yes. I mean, if you and I ran this business, it's not a disaster giving the landscape and what's sort of happened. But what happens is the market being very flighty and fickle goes, oh, it's a disaster. And it's like we go from a PE of 55 to 40. Now, 40 is still a high PE, but you do the maths on that. It's just sort of like it can squeeze you down a bit. So it's sort of it's something to be aware. There's what the business is doing. And then again, what the market is expecting that business to do. So I sort of look at a business like this and go, yeah, incredible history. That's really great. The market is definitely pricing in some growth. Will they grow more than that? And for what it's worth, the forecasts look pretty decent. 2025 estimate of 43 cents per share. So you can do it. And here's a nice easy hack, right? So I can always just go, I don't know. Every business, the more successful it gets, the more dominant it becomes, the less the growth opportunity becomes, right? Because you're winning the market. So the multiples tend to come down because as they fulfill on their promise, the opportunity set gets smaller in a lot of cases. So you can kind of go thumb suck right here. So let's say I can do it backwards. So the current share price is $13.26. Let's say I want a 10% return over 5 years. So 1, 2, 3, 4, 5. That means if I buy it today, I want a share price about $21.35 in 5 years' time. I'll give me a 10% return if I do that. And let's say that shares are on a PE of 30. And you can do a variety of scenarios here, but this is just a thumb suck to sort of see what if. That means that in 5 years' time, per share earnings need to be about 70 cents per share. Now, you can question those inputs and you can change them. And I encourage people to do that and play around with it. But you're looking at a business that at the moment's on 23 cents per share. So what you're really saying here, it's near enough a triple in profit in 5 years. Now, the great opportunity often happens because the growth is even more extreme than people expect and longer lasting than people tend to expect. So again, I'm not throwing shade here just to be nasty. I think you can go through this really basic maths to sort of say, well, what needs to happen? And I can tell you right now what needs to happen. One of two things for me to get my 10% return. I either need earnings to grow at that quantum that I have expected, or I need the multiple to expand even further. That's the maths, right?
Yeah.
PE equals price, or price equals the PE times the earnings. So one of those two things have to be at a certain level where when you multiply it together, I get, what did I say, $21 a share.
Yeah. Yeah.
And you don't know whatever the market's going to value it at, but at least you can kind of say, well, I think this is not an unreasonable rate of growth. And then as I did, I just worked out that, well, this is the kind of PE that I'm looking at. So the question is, do I think the market can support a PE for this kind of company that's demonstrated this kind of growth to get me to where I need it to be to get a return? Now, you might do a bunch of different assumptions and scenarios and come up with a different price. But that's great. You've now worked out a target price. So it might be that it's sort of like, well, not now, but I tell you what, if it ever got to, I don't know, 11:30, now I'm interested, right?
I like that. I like the thumb suck valuation methodology. Let me take that as a bit of homework and maybe I'll do it for these companies. Maybe if I find anything else that I think is interesting. But I think that's a good thing to go away with and work on.
Yeah, I hope it helps, man. There is such an allure with sophistication and spreadsheets, and I don't want to dismiss them. They certainly, but you know, you can. Buffett's so famous for never using spreadsheets and this kind of stuff. I mean, he uses these heuristics as far as we can tell, right? And he's not doing a DCF in his head, but he's just doing these big, broad assumptions. And it's just like you can start broad, then narrow down. If your first port of call is to crack open a spreadsheet and started trying to predict what the R&D budget is going to be 4 years out, and it's not that it's not a noble goal. It's just that it's diabolically hard, right? So keep it simple.
Love it. Thank you for your time and can't wait to do it again.
Man, I'm looking forward to it. I'm really enjoying these chats.
All right, Bryce. Well, that's the conversation that I had with Andrew. I learn a lot. The valuation stuff for me is really interesting and something that I'm going to go away and work on. I'm loving this series.
What we set out to achieve is sort of coming to fruition with us actually having more time and spending more time looking at individual stocks. I don't know about having more time, but trying to put away more time to be better at individual stock picking.
Well, it's something that your time can often be filled with other things. Got to make a meme for Instagram, got a full inbox. But knowing that this mentored session, this coaching session is in the calendar, it means you make the time to do it.
Yeah.
And it's something that I find really fascinating, but I often just don't make the time to do. So I'm loving it. Yeah.
Well, I'm going to try and beat you to the punch and find this company as well.
Okay.
See if I do.
Well, people are listening. Let's see if they know it as well. Hit us up on Instagram or at contact@equitymates via email or at equitymates.com/contact if you know the company or you can figure it out. As a reminder, the things that we know, it did more than $100 million in revenue in the past 12 months. Its market cap is about $10 million. It's based in WA and I think there was one. Oh, it's profitable.
Profitable. Yeah.
4 things we know.
It sounds like an app. Yeah. I'll put my filters on.
Yeah. Well, that's what I did. I just went to Ticker and if people want to go on Ticker and try and beat us to the punch, ticker.com/equitymates is the link.
Nice. All right. Well, we're going to have a bit of a break between sessions. I'm going to pick my next session up with Henry towards the end of May when I land back in Australia.
Yeah, you're just going to try and get good stock tips from the Berkshire conference.
I don't need good stock tips, Ren. I'm full of them. So looking forward to my next convo.
You're full of something.
with Henry. But as we said at the top, over the next few weeks, we're going to be coming at you with content from America, Omaha, New York, and we're also doing a Wealth Builders series where we look at some of Warren Buffett's best long-term investments and some of the key lessons that we have learned from him over the past few years of investing ourselves. It's been an absolute pleasure listening to you there, Ren. A call out and a shout out. If you're listening, can you please share this episode with one of your friends who would love to join the journey of investing and join the Equity Mates community? It will go a long way to helping us continue to grow the Equity Mates audience. But Ren, super pumped for the US. Make sure if you're listening at home, you're following along on our channels. Cannot wait. We'll pick it up next week.
Can't wait.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.